All right, so here we're going to be talking about what's behind printing money. The 1913 Federal Reserve Act is a legislation in the United States that created the Federal Reserve System. Congress passed the Federal Reserve Act to establish economic stability in the U.S. by introducing a central bank to oversee the monetary policy. A quote by President Abraham Lincoln: "The government should create, issue, calculate all the currency and credits needed to satisfy the spending power of the government and the buying power of consumers. By adopting these principles, the taxpayers will be save immense sums of interest, money will cease to be master, and become the servant of humanity." All right, so Americans rejected the idea of a central bank because it gives power to a few individuals to loan money to the government with interest. Central banks also create wealth inequality. There's also a boom and bust in the economy, and with every boom, the rich get richer and the poor get poorer. This continues until the system eventually fails. There's only two institutions that can create new money. The Federal Reserve Bank can create new money at will. Commercial banks create new money on demand. Oddly, the Federal Reserve Bank is not an actual bank, a reserve, or federal. The Federal Reserve Bank is a private organization. It consists of a board of directors called governors. They oversee banking systems located in 12 states. The U.S. government borrows its currency from this private organization. The governors give the U.S. Treasury permission to print new money. This is an interesting quote here. Um, Alan Greenspan, he was once the chairman of the Federal Reserve Bank, and he said this on a national broadcast. The Federal Reserve is an independent agency, and that basically means that there is no other agency of government that can overrule the actions we take. The government overspends what it receives in tax revenue. This is why most Americans are broke and in debt. We learn our bad habits from the best, Uncle Sam. The Treasury borrows money from the Federal Reserve Bank. The Federal Reserve simply prints new bills. Today, credit and debt is no longer a privilege, but it is a necessity for survival. Nearly half of Americans need credit cards to cover essential living expenses. This here shows a graph of how balances on credit cards that's been left over month after month have grown in different age brackets over the last year, and it continued over the last few years, but it continues to grow and grow and grow. Americans lean more on credit cards as expenses stay high. 40% of cardholders carry a debt from month to month. So banks know this. Banks know that um, people need these credit cards. They are dependent on it. They need the money to survive. As I said before, the middle class, they finance their lifestyle, and this is something that the banks know, and they know what's happening, and they're banking on it. No pun intended. All right, so these are a couple of definitions I think people kind of overlook. The definitions pretty much of what we use or we see as currency or as money. Legal tender is a bank note that must be accepted in payment of a debt. A bill is a statement of money owed. A bank note is a central bank promissory note. A note is a written promise to repay. So US currency is actually debt. The other institution that can create new US currency is the commercial bank. The banks are no longer required to lend capital reserves held in deposits. They can just create new currency upon request. The fractional reserve system. This is where I want to focus because this is how you're going to become wealthy. The more I study banking, the more it confirms money is unlimited, like literally unlimited. Most people think banks make big profits from fees and interest payments. That's only the icing on the cake. The bank's objective is to create more assets. A bank can literally type $1 billion on its balance sheet to increase its assets, but there's one problem. It's a big problem. So they cannot claim the asset if it does not cash flow. This is where you can add value because the banks need you more than you need them. Banks' assets and cash flow is limited by your purchase power. Your purchase power is determined by your consumer credit report, bank score, and also bank rating.